Yo guys, big news out of DC and it's shaking up markets in a big way. So President Trump just dropped a tariff bomb on what he's calling Liberation Day. And I'm not talking about a small bump here. We're looking at the biggest U.S. tax hike since 1968. A jaw-dropping 22% jump in effective tariff rates. Yeah, you heard that right. 22%. Now, if these tariffs actually stick around, economists are already throwing up the red flags. Recession level red. They're saying this could be enough to pull both the U.S. and the global economy into a full-blown recession by the end of the year. And the Fed? They're caught in a nasty squeeze. Rising inflation on one side, slower growth on the other. Yikes. On top of that, China didn't exactly send flowers in response. Nope. They fired back on Friday, jacking up tariffs on all U.S. imports by a whopping 34%. So yeah, this is now officially a trade war 2.0. So what's the Fed gonna do? Well, economists are betting on 6 straight rate cuts starting in June. That's 6 cuts in a row, folks. The Fed's basically stuck between, oh crap, prices are spiking, and oh crap, growth is tanking. It's a lose-lose unless something changes. Now markets? They're rattled. Risk assets are on shaky ground. The S&P 500 just hit 5,200. That's the downside target level analysts were watching like hawks. So yeah, we could see a short-term bounce, but don't get too comfy. The overall risk is still leaning lower, especially if the recession fears start feeling more like reality than risk. And hey, what about all those hot themes like AI in China or Europe's fiscal comeback? They're still in play, but the shine's dimmed a bit. The tariff shock could put the brakes on that rotation, at least for now. When it comes to strategy, keep it tight. Stay long on the short end of U.S. Treasuries. It's still the go-to hedge if things go south. If labor markets start cracking, the Fed's got room to ease, and they will use it. Plus, we're seeing similar plays in short-term bonds across developed and emerging markets. As for credit, spread products like EM sovereigns and corporates? Nah, we're underweight. They just don't look worth the risk right now. Instead, we're liking Mexico's 5-year Mbonos and 3-year Chinese government bonds. FX hedged, of course. FX game? We're short the dollar against low-yielders like the euro, the yen, and the Swiss franc. And EM Asia FX? Big underweight there. Tariffs are hitting those economies hard. Gold? Still a strong long. And oil? Yeah, we're short. Rising tariffs, slowing growth. Not a great setup for crude. Bottom line, Trump's tariff rollout hit like a wrecking ball, and the full economic impact hasn't even been priced in yet. The next few weeks of negotiations could change the game, but if nothing gives, this could be a year that investors won't forget anytime soon. So keep your eyes on the data, watch those central bank moves, and don't get caught flat-footed. All right, that's it for today. Hit that like button if you found this useful, and don't forget to subscribe if you want to stay ahead of the curve. Catch ya in the next one.